Hello and welcome to ONS Energy Talks. The topic of today is pandemic, uncertainty and turmoil, energy in 2020. My name is Anne Ekern and I am your host this afternoon. Our guest at this ONS Energy Talk is Mr. Kenneth Medlock. Kenneth Medlock is the James Baker III and Susan G. Baker Fellow in Energy and Resource Economics at the Baker Institute. He's also the Senior Director of the Center for Energy Studies. And for those of you not intimately familiar with the energy program at the Baker Institute, it's actually ranked as the #1 university think tank globally. Kenneth Medlock has a very impressive list of credentials and frequently features with articles and presentations internationally. Today, we will discuss how the current and global coronavirus pandemic has affected the energy markets and what we have to be prepared to deal with at least throughout 2020. We'll also look in more detail at carbon capture and sequestration, or CCS, and the potential CCS has to offer. Ken, we're really glad to have you joining us from Houston, Texas today.
Thank you. It's a pleasure to be here, Anne.
So first and foremost, how are you doing and your family and your team, and what is it like in Houston right now?
It's different, just like everywhere else. Sort of adjusting to a new normal of working remotely and being on web videos and web chats constantly. It feels like, but I think everybody's adjusting. I think the biggest adjustment here has not really been so much about workflow as it has been about just missing the interaction in the hallway with my colleagues. Those impromptu discussions are incredibly valuable, and I can definitely say that those are missed. And then aside from that, it's moving to an online format for teaching, which has been an adventure to say the least.
Do you think a lot of the changes you've already implemented in your teaching, do you think they're likely to last after this is all over?
I do not. I as a matter of fact, I could see where some of the online format for undergraduate curricula could stick and carry over. But I teach graduate students every spring, and a lot of that is team-oriented interaction, and it's difficult to do that in this kind of environment.
So they miss the interaction as well.
Yes.
So, but I guess you've all been very busy since this all happened because you're working with things right in the middle of all of this. Is that correct?
Yes. Tumultuous is probably the best word to use, and I often just kind of have to sit back periodically and remind myself, first of all, how lucky I am to be at Rice. But secondly, how amazing it is that we are having conversations about negative pricing, about state regulatory agencies in the United States stepping in and pro-rationing production, something that hasn't been done since 1972. I mean, the litany of things that we're discussing now, if you had asked me if we'd talk about these 6 months ago, I would have said there's no way, but here we are.
So I was going to touch on that negative pricing. So could you, and I read your blog about it. It would be really interesting to just hear what happened before we get into the bigger questions.
Absolutely. Well, it's kind of been one of these issues that what I'm about to address that's come up from time to time with the way futures are settled. The first thing to understand is the negative pricing phenomenon that we saw. It occurred physically as well as financially, and it's very much a result of fundamentals that are skewed largely because of an oversupply situation. But the dramatic collapse, just to put it into perspective, we opened the day on Monday of this week, so April 20th. Price opened at 17 and change at WTI. It closed down 37 and change for a collapse of just over $55 a barrel in less than 12 hours. The next day, it closed on the final day of trading for the May contract. It closed at just over $10 a barrel. So you saw a $55+ drop on Monday, and then a $48 roughly increase on Tuesday. That kind of volatility, when you annualize it, has literally never before been seen in the crude oil futures market. So, it's without a doubt unprecedented in many respects, but it also begs the question, what was actually going on? And there's been some really good stuff actually written on this in the Financial Times over the last couple of days. I myself wrote a piece on this that was published Tuesday in our spot on Forbes. But basically what it amounted to was an exacerbation of the underlying fundamental signal that the market was receiving. That's the thing about price, right? Supply and demand have to balance, and demand is really the collection of consumption plus net injections into storage. And when you run out of storage, you can end up with a severe oversupply situation. And that's exactly what we saw. And it was exacerbated by the fact that you had a large financial position that was long, that the holder of that position had no idea how to physically receive if they were left holding those contracts at expiry. And so they had to unload them. And that massive rush of dumping contracts or offsetting positions effectively really put significant negative pressure in financial markets, in the financial market for crude. And that's why futures crashed the way they did. Today, last time I looked, the prompt contract, so the June contract was trading in the mid 17s. That's still not a healthy price for oil production prospects, to say the least. And it is kind of funny. I was joking with a colleague. I was like, we're at 17 now, and people are sort of, in many respects, breathing a sigh of relief because it's not negative. But when you take a step back, you realize 17 doesn't pay for a lot of new investment in the sector. And again, going back to something I said a minute ago, who would have thought 6 months ago we'd be talking about 17 in a positive way? And that's kind of what you're seeing when you hear some of the discussions about price recovery from just Monday of this week.
So just touching on the US shale as well, since we kind of talked a bit, because we've seen a lot of, some of the US shale companies going into Chapter 11 already, right? And after the 2014, crash in the oil price, most of them were able to bounce back at least somewhat. Do you think that is likely to happen now? Because you already alluded to, the investment being cut and, with companies going bankrupt and not looking too promising on the price front.
Yeah, this year was going to be, so let's pretend we're in a world where COVID-19 never happens, right? This year was setting up to be a year of some trimming, if you will, in the U.S. upstream. Namely, there were some there are some shale operators, relatively, the smaller firms that have had significant trouble generating free cash flow for a better part of a decade now. And the investment community was starting to pull back from those firms. And so there was a general consensus that there was going to be a thinning of the herd, if you will, for the year 2020 in the shale patch. But what that generally means is assets change hands. And, typically you'll think about selling an acreage position, for example, to generate cash, to service debt, et cetera. But in a lot of ways, I think what COVID-19 has done is press the accelerator on that process. And it's probably going to end up being deeper than most people anticipated, obviously, as we came into 2020. But the one thing we have to realize when we talk about the future is that, yes, the near term doesn't look rosy at all. And in fact, we're likely to see, production decline because there's very little in the way of new investment coming into the space and new drilling occurring. So over the course of the next year or so, we'll see decline really set in, and we'll see a reduction in output. But the rock doesn't disappear. The asset is still there. And so what that means is that as those assets are picked up by other players, typically the larger players in the space, they bring a different scale into the field and into development. And what that ultimately could rot is an overall reduction in cost. I mean, you actually see, for example, when the majors step into these places, they can bring down costs, not only because of scale efficiency, but because of what that means, right? It's thinking about how those firms have, very deep connections up and down their procurement supply chains, what that means for how they negotiate for various costs for doing business in the field, what they can do on the automation front, which is something you're starting to see some of these firms do in the field. For example, there's some wells that are being run in the Permian that are operated remotely from Houston. Right. And so I imagine more and more of that to be the norm as the bigger players step into that space. And so that doesn't paint a negative picture for shale. It just paints a much more disciplined picture for shale.
So moving to the global energy market now, it certainly is in a meltdown. We've seen the oil price just spiral down. But there's a lot, and I know in Texas you're surrounded by a lot of renewable companies and renewable energy industry as well, and I believe they're suffering somewhat as well. Could you, how serious are the consequences so far, if you are to talk about like the industry in general?
Yeah, great question. And I always like to, when I'm talking about what's going on in energy, kind of take a step back and talk about what's going on across the economy, right? Because I think that gives us a better picture of what we're talking about in terms of scale and breadth and scope and everything else. Simple examples. These are anecdotal, right? And they kind of step outside of the energy domain, but I think it gives you an indication of how deep the pain is across economies around the world. There's a lot of airlines, carriers that have seen their capacity factors reduced down to roughly 10%. So that's a 90% drop in demand. We're not talking about that in energy at all, right? But that's what they're dealing with. I was actually speaking with somebody, a reporter for Business Week, who shared with me a story about a major hotel chain in Chicago where their capacity factor was at 1%. So that effectively represents a 99% drop in demand. And so when we talk about what's happening in energy, it's not anywhere near that severe, but we're seeing it in real time because the energy story is in your face all the time, every day. It's true across the board that everything's being impacted, significant reductions in load on the electricity front, to the point where there are, in the United States, some very robust conversations going on between energy service providers and PUCs about, how to actually manage an inability to pay, for example, by a customer who lost their job or has been furloughed during this time, and still allow the energy service provider to remain whole. So there's a lot of things that are moving, a lot of things that are going on. We saw last week a reported reduction of 106,000 jobs in the renewable energy sector. So that tells you a lot. Solar installations are down to next to nothing at the residential level. Projects that were already moving, they're still moving. That's true across all sources of energy: LNG, oil, pipelines, to the extent that legal impediments aren't being presented, as well as renewables. And you were it was very apt to actually point out, the state of the world here in Houston and in Texas. Texas has over a quarter of the United States wind capacity. So it is very much as we like to talk about it being the oil and gas capital of the world, it is very much the capital of wind energy in the United States. So every sector is feeling it, though, without a doubt. So, and I've said this before, but the only way really get things turning again is for the economy to start churning.
Right. The energy transition is not kind of very much a topic of this conversation, but I was tempted to just touch on it because
sure.
Some people say that this will speed up the energy transition, as in the move into greener energy, and others claim the contrary. Do you have some thoughts on that?
I do. First of all, it's there's a massive amount of uncertainty in engaging that question, and I've seen those kinds of conversations too. And I think it's important to point out that as much as we like to look to history to help explain what's going on and what might come next, this is different than anything any of us have lived through, or actually in the historical record, really. I mean, the reduction in economic activity that has decimated every sector of the economy, it's originated with the consumer. And when you think about previous economic downturns and reductions in demand, they're typically related to either a problem in manufacturing, a problem in the financial markets. We can go to real estate bubbles. We can talk about tech bubbles. I mean, we got all these things, but never did they originate with the consumer. And that's where this one started. And so we've seen this economic playbook that has been used time and again, promoting fiscal stimulus, monetary stimulus, et cetera, sort of exercised in this current environment. And it's unclear what that's going to mean. But make no mistake, the physical capital that's in place, so people's automobiles, industrial boilers, up and down every sector of the economy, that's all still there. It hasn't turned over. It's exactly what it was before COVID-19. Just similarly, the amount of fiscal and monetary stimulus that has been pumped into the system is going to make it very difficult for governments to pull another trigger on massive spending programs. So they're going to have to look to different means of generating revenue post COVID-19 when economies start to pick back up again, because the debt load is grown. And government debt's going to have to be serviced. And B, they're going to have to look to relatively low-cost ways to encourage innovation and energy transition. And so this really means, in a lot of respects, clearing pathways in the regulatory environment for the adoption of new technologies, or encouraging new sort of greener, if you will, energy technologies to matriculate into the system. Because at the end of the day, and this is what also is missing from a lot of those conversations, people have to buy them. People have to want to buy them. And consumer appetite for much of anything right now, other than going back to work and doing things like buying toilet paper, for example, we've all seen those stories, right? It's pretty low at the moment. So I think the story is still being written. I think there's a lot of uncertainty, and I think anybody who tries to tell you they know exactly what's going to happen, they're just making it up.
But very interesting to hear how value choices and consumer choices may play into dictating the price in the market going forward. So we touched on price, but in the oil market, we've seen a nasty price war between Saudi Arabia and Russia, with Trump kind of taking the role as the deal maker in this. Can you share some observations and reflections with regards to this situation?
Yeah, that's been an interesting one to watch. The price war, as it's been dubbed, following the OPEC meeting in early March, OPEC Plus meeting in early March. There's been a lot of ex post rationalization stating that it was really, engineered to target shale. But they seem like sound arguments. I'm not so sure. I think a lot of what transpired coming out of that March meeting was more emotional than rational. You got to remember, when that meeting started, the Saudis went into it looking for a 1.5 million barrel a day cut, and we came out within a month. They had increased production by 3 million barrels a day. So that's a 4.5 million barrel a day swing from the Saudis alone in terms of what their intent was. So I find it highly suspect to claim that the target was shale when they went into that meeting. Now, without a doubt, the Saudis and the Russians in particular have lamented shale's rise over the last 4 years, which is why I say this is likely some ex post rationalization. I mean, look, it's plain to see. After the last collapse in price that lasted through early 2016, where we hit $26 a barrel, and oil production in the U.S. from 2014 to 16 dropped by about 1.1 or so million barrels a day. Price support that was given to the market by the OPEC Plus contingent allowed U.S. shale production, U.S. oil production, more generally, to increase by almost 4.5 million barrels a day from January 2016 to January 2020. So that is a significant increase in oil output, all while Saudi in particular was withholding production. And so it does beg the question, how long could that status quo remain? And I think as we come out of COVID-19 and as demand starts to pick back up, I think that very much will be on the minds of oil producers everywhere and have a big impact on future production policy. But I don't think that the price war was a reaction to what happened with shale. I think it was more emotional. I think it was more of an argument between the Russians and the Saudis because the Russians were really underestimating COVID-19. I think everybody did, to be blunt, but they didn't actually think they needed to cut production at all. And that's ultimately where the disagreement came. So in many ways, when you look at the price war and what happened, there was a massive retreat, right? Because it underestimated, all the parties involved underestimated the demand destruction that was wrought by COVID-19. But when you look at how rapid that retreat came, the emergency meeting that was called, the agreement to cut production by significant amounts. This is where President Trump was involved in trying to play the mediator, if you will, to negotiate a deal, and that's actually extended much broader than just discussions between OPEC plus countries in the United States, with lots of countries coming to the table, and the idea of using the G20 as a format to negotiate coordinated output cuts. All these sort of things came into play, right? But as we look forward, it's apparent that even with those cuts, they're not enough, and so we still have to see markets work ultimately. And that's what you're starting to see with some of the announced production shut-ins that have been occurring. And the longer price stays at the levels it's been at recently, the more accelerated those production cuts will become. And it's going to be driven purely by commercial circumstance. Interestingly, if we stay in a $20 world, I fully expect given the fact that tank tops are filling up around the world, you'll see production cuts in addition to what we've already seen committed out of Saudi Arabia and Russia as well. So that's a big if-then statement. It's entirely contingent on demand. That's the thing that we always have to keep in mind. This is a demand story, and supply is just trying to rapidly catch up.
Right, because that was going to be my next question, asking you to predict how long it would be before we could see, if they were to stick with these cuts, before the supply demand would rebalance. But what you're saying is that it will take more.
Yeah, in the current state of the world, yes, because we're running out of storage capacity rapidly, to the point where there's, last report I saw, in excess of 200 some odd thousand barrels sitting in a day in terms of capacity, sitting in tankers, right, floating. And tank tops at Cushing are already fully committed. That's a report that we saw yesterday. So you run out of place to put oil. And so at some point, producers have to recognize there's nowhere to put this stuff unless we want to dump it on the ground and let it turn into tar, which is actually what used to happen in places like Texas before the Railroad Commission got involved, right? But hopefully it won't come to that, and some real rationalization of the future monetary value of oil production will come into play, and you'll see production cuts that preserve that value more near term. I will comment on that, just because I think it's important for people to understand. When a producer, a commercial producer in particular, decides to shut in, the shut-in costs become very relevant. And there are some actions being taken by state regulators in the United States to try to reduce those costs. So actions being taken, for example, to allow producers who hold leases on state lands to shut in production without losing the lease. That's a big issue, right? Because the commitment that's already been made they're valuable assets. And the last thing you want to do by shutting in is lose the lease because you violate the contract. And so there are steps being taken to effectively reduce the cost of shutting in, which should help accelerate shut-ins occurring much more rapidly.
Mm-hmm. Thanks for that. So, sure. The U.S., looking at the current situation, the U.S. is now the largest oil producer, Saudi Arabia, the largest oil exporter. But when you look at demand, Asia is the driver, with China and India in the front seat. They're driving the demand side, driving demand growth, a lot of that coming from the transportation side, and that's likely to continue. Could you kind of elaborate or reflect on the dynamics stemming from this balance, or maybe lack of such?
Yeah, so happy to. Historically, and this has kind of been one of the biggest transitions in energy markets, if you will, over the last 15 years. But and it's often sort of left out of the context of energy transitions. But demand growth in Asia has been a massive driver of shifts in geopolitical discourse, shifts in energy trade, and it portends to be, ever more so as we move forward, largely as India grows, as China continues to grow, as manufacturing continues to expand, particularly in the textiles fronts in ASEAN countries. So there's a lot of interest in serving that demand, and there has been a shift in the way investments and value chains are being developed. Everybody's aware of, Chinese influence in Africa and other places to try to, secure resources for future economic growth. And all that, I think, once we emerge from COVID-19 will continue. Because make no mistake, all those countries, one of their first and most important goals, beyond human health and safety of the populations is economic growth, so welfare improvement, and you need energy for that. And there's a lot of existing networks in place that will again be leveraged, and so I very much expect to continue to see that occur. And I think there's another really important point that needs to be made there, because it goes back to your question about energy transitions. Asian countries, when you just think about the populations of China, India, Southeast Asia collectively, it represent roughly 3.5 billion people. So that's a massive chunk of the world's population, and they're all wanting to grow. Historically, when we've talked about energy trade and geopolitics, it's been focused on Europe and the United States. And just to put that into perspective, the collective populations of those regions of the world are just north of 1 billion people. So you're talking about a scale that we've never dealt with before. And so that means all energy sources are going to be needed. It means Asia will continue to drive what's happening in energy discourse, energy geopolitics, very much be a centerpiece of discussions for decades and generations to come on the energy front.
Thank you. I wanted to move to gas. A lot of gas producers, they would claim that the price has been too low for too long, and it hasn't gotten any better. How do you see the development in the gas price going forward?
Well, I mean, natural gas globally is seeing similar things to what we're seeing with oil. The U.S. has moved into a position of exporting natural gas. There are a number of export projects under development. LNG, large proportion of those supplies are targeting Asia, although they land all over the world. There have been some projects in the wake of COVID-19 that have been delayed because securing offtake has become more difficult, as you might expect. It's anytime you have an injection of uncertainty of this magnitude, it should cause large capital projects to hit pause. Because you got to wait and kind of gather more information so you can figure out exactly what's going to come next, because this is a level of uncertainty that, A, it's unprecedented, but B, it actually just creates a lot of risk up and down value chains and across all types of different investments. So on the natural gas front, it's very much a similar kind of story. Power demand's been hit negatively. Industrial demand's been hit negatively. And so natural gas prices have actually softened globally. Interestingly, in the United States, because of what's happening to oil, the picture has not been quite as bad for natural gas. As of yesterday, price at the Henry Hub was trading around $1.90, which is actually up from where it was earlier this year. And some of what's driving that is the storage position. Some of what's driving that is the fact that so much of U.S. natural gas production now is really driven by oil production. So there's a lot of associated gas production. So as oil markets suffer, gas supplies will dwindle, and that can actually lend support to gas markets. So how this plays out, I mean, we're talking about things that have happened over the course of a couple of months, but how it plays out long term and what it means for project development, again, it goes back to demand. It really is about what happens in the power sector, what happens in the industrial sectors around the world that are so dependent on natural gas as a source of fuel. And of course, that's driven by economic activity.
Yeah. And it's very correlated, as you say, to the oil production too, which is And I wanted to just touch on your neighboring country, Mexico, where they had a recent energy reform and everything. So I just kind of wanted to touch on what are we likely to see there in, you know, as an energy country, as an energy producing country.
You saved one of the hardest questions for near the end, huh? Mexico is an enigma. The commercial prospects for the Mexican energy sector are robust, to say the least, when you look long term. The investment horizon looks very positive if you just consider those commercial prospects. But the problem ultimately comes when you get an increasing overlay of heavy-handed policy. It's injected uncertainty. It's caused companies to pause even before COVID-19 and kind of begin to rethink their engagement in the sector. Companies that were already in are continuing to push forward and hoping, that by the time you get some of these major deep water offshore projects developed, there could be a different leadership in place in Mexico that's much more friendly. And so you've already got a big sunk cost, and so you continue to push forward. But make no mistake, when you look at what's happening with the push to, by López Obrador in particular, to push, encourage increasing growth and output, restore strength, if you will, to use the turn of phrase that's been used in the Mexican oil sector. Pemex is a national champion, et cetera. That's almost like a back to the future type discussion, because we thought, most people did anyway, that once the energy reforms were ultimately enacted, you'd see a much heavier commercial footprint. But it's looking increasingly like that is being, at the very least, delayed. And who knows, it might actually be delayed indefinitely, depending on what happens going forward. But, it's an interesting country to examine. And I've got some colleagues who are looking very closely at it, and they're much more adept at addressing the Mexican political situation than I am. But make no mistake, the investment opportunity seems to be diminished quite substantially right now.
Thank you. So we wanted to touch on the topic of CCS as well. Yes. And I wanted to start the first question combining maybe two topics, because some people have argued that with this situation, we may see carbon taxes being introduced to a larger extent that you see today. Yeah. And carbon taxes, may help CCS projects become more commercial. Could you talk about that relationship? How much would it take in introducing carbon taxes? What is the potential for CCS?
So I'll address the likelihood of carbon taxes first, and then talk about carbon capture technologies or sequestration technologies, because we're involved in on several different fronts on that have a Texas focus, but an international appeal, if you will. So coming out of COVID-19, given I mentioned earlier the amount of fiscal stimulus that's been incurred, one of the things that's going to be on the table for discussion is going to be, just in terms of generating government revenue, is going to be implementing a carbon tax, because all bets are off now because of the amount of spending that's occurred, and the government's going to be looking for ways to generate revenues, and a carbon tax might be one of those means that would be politically expedient, quite frankly. Of course, the devil's in the details, and that's where you get to the connection with carbon capture. One of the ways that some firms might be able to avoid that tax liability is through demonstrated efforts to deploy carbon capture technologies. I mean, we already have a 45Q in the United States, which is really designed to provide effectively a tax-based incentive to deploying carbon capture technologies. But make no mistake, companies are looking at this. I mean, that's one of the reasons the Oil and Gas Climate Initiative was created. It's they identified locations around the globe to create effectively carbon hubs, which are really hubs for research or market-oriented outcomes, et cetera. It kind of just depends on the region. But industry is looking at this, and they continue to look at this. That interest has not waned. What we're doing is looking specifically at the industrial emissions footprint in the state of Texas. And that's just to kind of take to it from a high level down to a much sort of close-up level. Why just look at the state of Texas? Well, because in our initial sort of research on how do you deal with climate forcing agents, we started to realize that the solution in one part of the world won't necessarily fit in another part of the world. Some of that has to do with economic opportunity. Some of it has to do with regional and geographical endowments. Some of it has to do with social pressures and political acceptance. But one of the things that definitely came out of this was, politics are local. It's that old adage. And so if you really want to see something move forward, in many ways, you're going to have more success if you can appeal to a local constituency. And so we started to focus on Texas initially, and have a lot of interest locally from industrial sources of CO2 to participate in this. But the idea is to think about how to clear regulatory pathways for broader adoption of CC, carbon capture, and utilization of carbon, which effectively means addressing a lot of regulatory impediments that I think most people aren't really aware exist at a local level, that the federal government really can't address. And so we've been actively involved in discussions on this front with some of the state legislators, as well as the governor's office, trying to sort of figure out how to get easy wins, if you will. And one of the things that's interesting about COVID-19 is it's really increased the appetite for easy wins. Things that aren't going to cost money, but maybe clear regulatory uncertainty from the field. Because that's the one thing that you have to also recognize, is that even if a carbon capture technology would be commercial in its own right without any government assistance, if there is any uncertainty in the regulatory environment around the deployment and use of that technology, it will kill the project in its tracks. And so we're trying to clear those hurdles. So there's a lot of interest in this, and it will have a big impact for the United States, because Texas actually is responsible for the industrial complex in Texas is responsible for about a quarter of the United States industrial CO2 emissions. So if you can do something in Texas, it will go a long way to addressing emissions across the United States. We're also involved in nature-based solutions. So the idea here was really by one of my colleagues here at the Baker Institute, Jim Blackburn. He's an environmental lawyer, but his idea was to try to figure out a way to monetize soil carbon storage as a property right. This has a lot of appeal to landowners, as you might imagine, and it can actually be enhanced relatively simply just by encouraging changes in land use patterns. It also has a dual goal, particularly when you get into coastal areas, of addressing concerns about erosion because you allow certain native grasses to expand and proliferate. So, these kinds of things ultimately generate interest by creating demand for CO2 uptake and supply on the land side, but also supply from the standpoint of an industrial emitter, and demand if you're talking about carbon capture and utilization by somebody who's going to turn carbon into something that will ultimately generate some value. And so the premise behind that is that if it works and you create enough depth so that you get a lot of suppliers and a lot of demanders moving into the space, now all of a sudden you have a price that reveals itself, and the impetus for policy overlay becomes much more limited. And when you look at the success of markets, typically when there's less government intervention, the markets take off and operate much more rapidly and efficiently. So our hope is that if we can get these two things moving quickly in the state of Texas, it might provide a model for other regions to follow where it fits, and ultimately help to abate carbon emissions much more rapidly at a global scale.
So it sounds like both there's quite a bit potential, and within very different areas and different projects as well. Yeah. I was just interested, maybe to conclude the topic of CCS, and we're approaching the end. Are CCS projects just something for developing countries, or is that something that, for developed countries, or is it something that developing countries would be able to implement and benefit from as well?
Yeah, it's something that anybody could implement. It's not really about technical feasibility there. I mean, it's, if you have storage capability, and you have the know-how, then it can be done. It really becomes about it comes about the economics of the situation, which is why we're so interested in thinking about how to create marketable opportunities for carbon capture and ultimately sequestration. And so when you look around the world, that's why typically we see these interests being most emphasized in countries that are developed, because you typically have wealthier societies, wealthier governments, wealthier operators, much more sort of healthy interaction, if you will, between operators and regulators in terms of trying to clear pathways and making these things commercially viable. But that's actually important, because in a lot of ways, it's about proof of concept and driving down cost. And then once you can do that, you begin to deploy this in other places around the world, I think, with great success, even where some of those precursors that you have in the developed countries of the world don't exist. So I think that's why markets are incredibly important for driving success in this space.
Great. We've covered a broad range of topics. Are there any final comments or messages or anything you would like to close out with? Something we should have touched on in this turmoil?
We've gone through a lot. The one thing I will say, just because I've had this conversation with a lot of folks, a lot of grad students who are, as you might imagine, incredibly nervous right now. We are successful with the Rice administration for our grad program to extend the program through December. That way they don't have to go out into the market in September. Incredibly important for them. But I just keep telling them to stay focused on your circle of influence, because if you can do that, the stress vectors will tend to fall away and be much less severe. And you'll be able to weather the storm more successfully, because I hate to say it, but when you turn on the news and just watch the feed, the 24/7 feed, it can become very depressing. And I think it's important to focus on what you actually have influence over. And, in a lot of ways, that's, making sure you're adhering to the stay-at-home rules, making sure that you're adhering to social distancing, making sure that you're doing things to remain productive, because at the end of the day, we're all going to have to be productive citizens again. And doing so in a safe and healthy way now will ensure that we can do so in the future. So that's really the only thing I want to say. And I wish everybody the very best as they navigate these really uncertain times. That's
a great final note to conclude on. Thanks so much for taking the time and joining us today and share all reflections on a number of topics.
It was my pleasure, and we could go on for another 10 hours, I'm sure, but it was a pleasure being here.
Yeah. Thank you so much again.
Thank you.
Thanks for watching the ONS Energy Talks. Please watch our streams every Tuesday and every Thursday at 2 o'clock and at ons.no. Thank you so much.